You're 62, you've got $450,000 in your RRSP, and there's probably at least one person in your life you've thought about cutting off. Maybe it's a relative who keeps asking for money. Maybe it's an adult child who borrowed $40,000 years ago and never paid it back. You're tired of the strain, and the standard advice always points in the same direction. Walk away, move on. You'll feel better. But here's what that advice almost never mentions. If you are still legally married to that person, or were living common law, walking away without a formal separation agreement can cost your surviving spouse up to 60% of your CPP survivor benefit. The 2026 maximum CPP retirement pension is $1,507.65 a month. At 60%, your surviving spouse stands to receive up to $904.59 a month. That is nearly $10,855 a year. Over a 20-year retirement, you are looking at more than $217,000 in pension income that disappears quietly because nobody filled out the right paperwork. I've spent years working with Canadians on retirement income planning, and there are 7 things I used to think were the right call that I don't do anymore. Some involve family decisions, some involve CPP, OAS, and tax rules. Most of them cross over in ways that catch people completely off guard because the Canadian pension system has its own logic that does not always match the standard lifestyle advice. The cost of getting these wrong does not arrive all at once. It comes in a few $1,000s a year for decades until the retirement plan no longer looks the way it was supposed to. If you are a Canadian near or in retirement who wants to protect what you have built, hit subscribe right now. I'll walk through all 7 in this video, starting with the one that almost nobody thinks about until it is too late. Here is the number that matters right now. The CPP survivor benefit is set at up to 60% of what the deceased was collecting. If the higher earner in a couple was receiving the 2026 maximum CPP of $1,507.65 a month, the surviving spouse could receive up to $904.59 a month. That is nearly $10,855 a year. And if you make an emotional family decision without any legal paperwork in place, you may not just lose the relationship. You could lose that income too. But here is what makes this tricky. The Canada Pension Plan does not look at whether you are on speaking terms with someone. It looks at marital status and legal dependency. If you are still legally married and you separate without filing a formal written agreement, your estranged spouse remains eligible for your CPP survivor benefit after you die. It does not matter how many years have passed. The government looks at paper, not feelings. And without that paper, an emotional decision becomes a potential $10,855 a year problem that can run for 20 years or more. I used to believe walking away cleanly was the right move. I told a client in 2019 to do exactly that. 6 months later, he passed away, and his ex-wife filed for 60% of his CPP. They had been separated for years, but there was no formal agreement on record, and she qualified. His new partner received nothing. That case changed the way I approached this type of decision completely. Think about Mark. He is 64, a retired truck driver from Thunder Bay, and his adult son owes him $40,000. He is thinking about cutting the son off entirely. He also has a wife who is 58 and will likely outlive him. Without a written agreement that addresses that unpaid loan and without a will that reflects his actual family situation, Mark's estate becomes complicated and his wife's monthly income takes a hit. The relationship problem and the financial problem are the same problem. The documents that solve this are not complicated. A separation agreement if one is needed, an updated will that reflects current family reality, and if money has changed hands and there are ongoing obligations, a written family financial agreement that spells out what is owed, what the boundaries are going forward, and what happens to that debt in the event of death. These documents do not end relationships. They protect you if a relationship eventually fails. This is not about being cold or calculating. It is about recognizing that Canada's pension system has rules, and navigating those rules correctly requires paperwork, not just good intentions. The invisible cost of skipping that paperwork can reach 6 figures over a long retirement, and most people only discover this after someone has died. The first thing I stopped doing is making emotional family decisions without a financial framework behind them. But there is a second thing that quietly drains retirement plans for thousands of Canadians, and it starts with a number most people have never calculated for themselves. Here is a calculation most Canadians in their 50s have never actually sat down to run. The average CPP for someone starting at 65 is currently around $830 a month. The maximum OAS at 65 right now is $743.05 a month. Add those together for one person, and you get roughly $1,573 a month from government sources. For a couple where both spouses are collecting at those levels, that doubles to about $3,146 a month. The problem is that median Canadian retirement spending runs between $4,500 and $5,500 a month. That leaves a gap of $1,350 to $2,350 a month that has to come from somewhere else. Your RRSP, your TFSA, a workplace pension if you have one, and if none of those are large enough, the math gets uncomfortable quickly. CPP was designed to replace about 25% of average working income. The CPP enhancement is slowly pushing that toward 33% over time. But that still means roughly 2/3 of your retirement income needs to come from private savings or other sources. Treating government pensions as your primary income is not a plan. It is a gap that grows every year. You do not plan around it. I have watched people approach retirement with their entire income picture built around CPP and OAS, and then spend their first 5 years drawing down their RRSP faster than they expected because the monthly numbers did not add up. That unplanned drawdown triggers more taxable income. More taxable income moves them closer to the OAS clawback threshold, and suddenly they are in a worse position than if they had built a clear income plan from the beginning. The shift that matters is one of framing. Treat CPP and OAS as your income floor, not your total retirement income. They are a guaranteed baseline and a valuable one, but they were not designed to carry a full retirement lifestyle on their own. Knowing your actual income gap before you retire is the most useful calculation you can do. Not a projection, just a real number you can plan around. Once you know that number, you can work with it, and that work connects directly to the next thing I want to cover, because there is one specific dollar threshold in Canada that catches thousands of people off guard every single year, and most do not know it exists until they have already crossed it. The 2026 OAS clawback threshold is $95,323 in net income. For every dollar above that line, you pay 15 cents back to CRA. If your income hits $110,000, you are $14,677 over the limit. That is $2,200 returned to the government that year. Over 10 years of retirement at that income level, you have quietly sent back $22,000 that you counted on keeping. The trigger is rarely what people expect. Most picture high earners hitting this, executives with large investment portfolios and defined benefit pensions. But the more common case is a large RRIF withdrawal after turning 71, or selling a property that generates a taxable capital gain, or a combination of CPP plus OAS, plus a small workplace pension that pushes you just over the line, and most people do not notice it until they see their tax assessment. I know a retired teacher who sold her cottage in her first year of retirement. The sale generated a capital gain that, combined with her CPP and OAS income, pushed her net income well above $95,000. She had to write a check to CRA for over $2,000 to repay part of her OAS. She had been looking forward to that sale for years. The bill was a complete shock. She still brings it up when the subject of retirement planning comes up. The window most people miss is the period between 60 and 71. Before mandatory RRIF withdrawals begin, you have some control over how much taxable income you report each year. Using those years to draw down your RRSP gradually, while your income is lower, spreads the taxable amount across more years and can prevent a large forced withdrawal at 71 from pushing you over the threshold. Your TFSA is the most useful account in this situation. TFSA withdrawals are not counted as income for clawback purposes. If you need extra cash in a year when your other income is already high, pulling from your TFSA keeps you below the threshold. That is a move worth building into your plan years before the threshold becomes a live concern. The fourth thing I stopped doing is ignoring the clawback and assuming the numbers would sort themselves out. They rarely do without some planning. And there is one more quiet cost in Canadian retirement that I want to address next, because more people carry this into retirement than most financial conversations acknowledge. The average Canadian retiree carries roughly $20,000 in debt into retirement. At a 7% interest rate on a line of credit, that costs about $1,400 a year just in interest. That is, money leaving your budget every month, and unlike during your working years, you cannot earn more to cover it. The full cost is higher when you add the opportunity side. The $1,400 a year going out in interest is money that could have been invested and compounding instead. Run that through a 20-year retirement, and the combined impact of the interest paid and the returns you gave up adds up to roughly $40,000. That is not a rounding error. That is a meaningful portion of your retirement income for several years. Carrying debt into retirement also creates a tax chain reaction. If your monthly cash flow is tight, you may find yourself pulling more from your RRSP or RRIF than planned just to cover the interest payments. Those extra withdrawals are fully taxable. They push your net income higher. And that higher income moves you closer to the OAS clawback threshold we just discussed. A debt problem becomes a tax problem, which becomes a clawback problem. Each layer compounds the next. The pattern I see most often is what I think of as the deferral cycle. People in their late 50s say they will pay off the debt next year, once the kids are settled, once the renovation is done, once income feels a little more stable. And by the time retirement arrives, the debt is still there. Now they are managing it on a fixed income instead of an employment income, and that is a completely different kind of pressure. What I use now is a firm deadline. Set a target 12 months before your planned retirement date. That is your zero debt goal. Work backward from there. Attack the highest interest balance first and put every extra dollar toward it until it is cleared. Then move to the next one. The order matters because interest compounds against you every day you carry it. Getting into retirement without debt is not about being financially perfect. It is about not starting the next chapter already behind before you have had a chance to settle in. And when you do start drawing from your retirement savings, the question of how you pull that money out turns out to matter just as much as how much you saved in the first place. If you have $500,000 in your RRSP and you convert it to a RRIF at age 71, CRA requires a minimum withdrawal of 5.28% that year. On $500,000, that is $26,400, you must take out whether you need it or not. If you are already collecting CPP and OAS, that mandatory withdrawal can push your combined income well above the OAS clawback threshold before you have spent $1 of your own choosing. This is the trap that catches people who did everything right during their working years. You built a substantial RRSP. You deferred taxes while your income was high. And now the same account that helped you reduce taxes on the way in is generating mandatory taxable income on the way out, at a rate that increases every year after 71. At 80, the RRIF minimum is 8.75%. At 90, it is 20%. The income order I follow now is a deliberate sequence. Non-registered accounts first, where capital gains are taxed at a lower rate than regular income. Then the RRIF minimum, which CRA mandates. Then TFSA withdrawals for anything extra, because TFSA income is not counted for clawback purposes. Following that order keeps your taxable income lower each year and gives you real control over what you pay. This withdrawal plan also connects back to the family financial agreement I mentioned at the start of this video. When you have a written sequence that specifies which accounts to draw from and in what order, and what happens if a health event removes your ability to manage these decisions yourself, the people who need to step in do not have to guess. The plan does double duty. I check my own withdrawal plan every January. It is a simple review of which accounts to draw from that year, what the tax picture looks like, and whether any one-time event is going to change things. It saves me thousands a year. It takes less time than you would expect. It does not need to be complicated to be effective. It just needs to exist and be revisited. But even the most carefully built withdrawal plan runs into one scenario that most people have not accounted for, and it is not a market downturn. You are 58, still working, and a serious health event happens. A stroke, a heart attack that requires months of recovery, a cancer diagnosis that means you cannot work for the next year or longer. Your income drops to zero. You are still 2 years away from the earliest CPP retirement at 60, and 7 years from when you plan to stop working. Most people at 58 have no financial plan for this scenario. They have always assumed they will keep working until they choose to stop. A health crisis does not give you that choice. The CPP Disability benefit is designed for exactly this situation. The 2026 maximum is $1,741 a month. That is real income, but it requires a formal application, medical documentation, and approval from Service Canada. The process takes months, sometimes close to a year. If you need to cover 18 months of expenses while you recover and wait for that approval, most people reach straight into their RRSP, and those withdrawals are fully taxable at exactly the moment you can least afford a large tax bill. The comparison that matters is this. If you need to bridge 2 years before early CPP retirement at 60, and you qualify for CPP disability near the maximum, the total benefit over those 2 years is roughly $41,789. Compare that to withdrawing $41,789 from your RRSP to cover the same period, which at a combined marginal tax rate could trigger a bill of over $10,000. The cost of not having a health crisis plan is not theoretical. It has a real number. This is where Mark's situation becomes directly relevant to his wife. He is 64, but she is 58. If something happens to Mark, she is not just managing the medical situation. She is also trying to figure out which account to access first, what the unpaid family loan means for the estate, and whether the CPP disability approval will come through before the savings run down. Without a written sequence prepared in advance, those questions land at once under enormous pressure. The plan that prevents this does not need to be elaborate. A written health crisis sequence covers which account gets accessed first, which comes second, and who to contact at each step. One page, shared with the right person ahead of time, prevents 5 separate financial problems from arriving simultaneously when you are least equipped to handle them. The 7th and final thing I stopped doing requires no paperwork at all. It is something most of us carry quietly for years, and it costs more energy than it is worth. I have a file that contains some of my worst financial decisions. A position I held far too long. A purchase that made no sense in hindsight. Money that left and will not come back. I do not open that file anymore. At 60 or 65, replaying financial mistakes from your 40s is not just unproductive, it has a real cost. The mental energy spent on decisions you cannot change is energy that is not going toward the ones you still control. I have seen people so focused on a bad investment from a decade ago that they miss the planning moves sitting right in front of them. Regret becomes its own kind of tax. The feeling is completely normal. If you started saving late, or lost a significant amount in 2008, or pulled money from your RRSP early during a difficult year, those are hard chapters to carry. Most Canadians have at least one financial decision they wish they had made differently. That does not define what comes next. The shift that actually works is this. Stop asking what you should have done. Start asking what you still have. You still have time. A person at 60 typically has 25 to 30 years ahead of them. You still have decisions in front of you that carry real dollar values. When to start CPP. How to sequence your withdrawals. Whether to split income with a spouse to reduce your combined tax bill. How to protect the pension benefits you have already earned. Getting those right in the next 5 years can mean tens of thousands of dollars in better outcomes over your retirement. Dwelling on the last 20 years adds nothing to that. The right CPP timing decision alone can mean over $30,000 in additional income over a long retirement. The withdrawal sequence we covered earlier can save thousands more in taxes every year. These are the levers still available to you. They matter more than anything from the past. The 7 things I covered in this video are all things I stopped doing because the quiet, compounding cost of continuing them was too high. You do not need to have gotten everything right to get your retirement on track. You just need to stop doing the things that drain it slowly. If you want to keep building a clearer retirement picture every week, hit subscribe. Let's bring this all together. Remember Mark, the retired truck driver from Thunder Bay? He started this video with 2 problems at once. A son who owed him $40,000 and a relationship close to breaking. A younger wife at 58 who depends on his CPP survivor benefit for her financial future, and no clear plan for what happens if something goes wrong before he is ready. He used a family financial agreement to set boundaries with his son without walking away from the relationship entirely. He updated his will to reflect his actual family situation. He built an income withdrawal plan designed to avoid the OAS clawback. And he put together a 1-page health crisis sequence so his wife knows exactly which accounts to access and in what order if something happens to him. None of these were complicated changes. They were all things he had been putting off, not because they were difficult, but because they were uncomfortable to think about. Once they were written down, the plan stopped feeling like a burden and started feeling like a foundation. You do not need to have done everything right to get your retirement working in your direction. You just need to stop doing the things that quietly cost you. If this video helped you see your retirement plan a little more clearly, please give it a like and hit subscribe. I put out a new Canadian retirement strategy every week. Good luck.